Problem 18-31A. We're going to create a cost of goods manufactured, and then we're going to create an income statement. So we're going to start off with a schedule of cost of goods manufactured, as mentioned several times before. The schedule of cost of goods manufactured is basically based on this formula. So we're going to start with beginning work in process, and then we're going to show the amount of raw materials used. So Yum Yum Treats manufactures its own brand of pet chew bones. At the end of the year, the accounting records show the following. So prepare a schedule of cost of goods manufactured for the company for the year ended December 31st. For accounts with a zero balance, make sure to enter a 0 in the appropriate column. So as we said, we need to start with the beginning work in process. And work in process, the beginning is right here. Work in process is right here. So we have 0. So we had 0 at the beginning of the year. We had 0 pet chew bones in process. Now we need to calculate our direct materials used, which is, as I said before, is this formula here. So we need beginning inventory of materials. Beginning raw materials inventory. Raw materials is right here. So we got 13,100. I can copy and paste that. And now we need our purchases. So do we have purchases of raw materials? Right here. So I can copy and paste 30,000. Purchases of raw materials. All right. So we started with 13,100. We purchased 30,000 more. So how much did we have available for use? Raw materials available for use, 13,100 plus 30,000 is 43,100. Okay, and then going back to our formula, we then need to subtract ending inventory, and that gives us the amount of materials used. So now we need to subtract the ending balance. Ending raw materials inventory. The ending balance is 8,500. Copy that. Paste it here. So we had 43,100 available. We ended the year with only 8,500. So we must have used the difference. I'm going to put a minus sign in there just to show you that we are subtracting. They will accept it. The minus sign is not required. So when we do the math, 43,100, subtract 8,500, we get 34,600. So that means we've used $34,600 of direct materials during the year. All right. So back to our formula. After direct materials, we need our direct labor and manufacturing overhead. So direct labor, we've got 18,000. I'm going to copy and paste that. Direct labor. Scroll down. Now manufacturing overhead, there is no calculation. We need the details. So for this schedule, they want to show the details of manufacturing overhead. So we're going to look over here, and which ones of these are manufacturing overhead. Now remember, manufacturing overhead, those are costs that are, one, they have to be related to the product, related to making the product. So sales has nothing to do with making the product. So that is not manufacturing overhead. So again, to be manufacturing overhead, it has to be related to the product, and it cannot be directly traced to certain products. So in other words, it's not the raw materials and it's not the direct labor. So we've got plant janitorial services. All right, so these are the salaries for the janitors. And these janitors work in the plant, and the plant is where the product is made. So this is a product cost. But can you trace the janitorial salaries to certain chew bones? No, you can't. So this is an indirect cost, and it's technically indirect labor, but that falls under manufacturing overhead. So plant janitorial services is our first manufacturing overhead. $800. Sales salaries, that is for selling the product, not making the product, so that is not a product cost. Remember, manufacturing overhead is a product cost. Delivery costs, this has to do with selling, so it is not a product cost. Sales revenue, that's not even a cost, that's a revenue. Utilities for the plant. All right, so the plant is where we make the product, so this is a manufacturing overhead. Utilities for plant, 1,100. And the next one, we got rent on the plant. And of course, the plant is where we make the product, so that's a product cost. And rent, you can't trace it to any certain product, so this is a manufacturing overhead cost. $16,000, copy and paste, rent on the plant. So we're going to add these up, 800, 1,100, and 16,000. That gives us $17,900 of total manufacturing overhead. So here's our product costs. We've got direct materials, $34,600, direct materials used. We've got direct labor, $18,000. We've got manufacturing overhead, $17,900. Now, what we're going to do is we're going to add up these three, and that gives us a total manufacturing cost incurred during the year. So $34,600 plus $18,000 plus $17,900 gives us $70,500. All right. So now don't forget, up here, we could have had a previous balance. So if there was a previous balance, whoa, hold on here. If there was a previous balance, we would take this previous balance and then add it to the costs incurred, and that gives us the total manufacturing cost to account for. Obviously, it's going to be $70,500. Okay, and then what do we do after we get our total manufacturing costs to account for? We subtract the ending work in process. So ending work in process. And we get that from work in process ending. We got 2,500, copy and paste. So remember, we're subtracting that. It's optional, put in a minus sign. I like to put the minus to remind me to subtract. So 70,500, subtract the ending, gives us cost of goods manufactured of $68,000. Okay, so what we've just calculated is this cost of goods manufactured, which is also the same as right up here, whichever method you like. All right, now we're going to do the income statement. So why did we not do the income statement first? Well, for the income statement, you need cost of goods sold. And before you can do the cost of goods sold, you need cost of goods manufactured. So let's start preparing the income statement for Yum Yum Treats for the full year. So we're going to start off with our revenue, which was right here. So we got 105,000, copy and paste so I don't make a typing error. Sales revenue. And then if they had sales returns and allowances, you would subtract them. If they had sales discounts, you would subtract them. They don't have any of those, plus they don't have any space for those. Okay, next we have to calculate cost of goods sold. How do you calculate cost of goods sold? Well, it's right here. Cost of goods sold is right here. How do we calculate? You take your beginning finished goods inventory, add your cost of goods manufactured. That gives you the amount of goods available for sale. Subtract your ending inventory of finished goods, gives you your COGS. This is probably easier to understand down here, the T account method. You start with your beginning finished goods. You add in the costs, the additions, the costs of the goods that were created this period. This is our amount available for sale. So using these numbers, if we had 17,000 available for sale, we ended up with only 6,000, then how much must we have sold? We must have sold the difference, 11,000. So we need to start with beginning finished goods inventory. So here's our finished goods inventory. Beginning is 0. Beginning finished goods. Next, we said we needed to add cost of goods manufactured. Notice cost of goods manufactured is not on here. Why? Because we already created it up here. Cost of goods manufactured, 68,000. And if I want to avoid a typing error, copy, paste, cost of goods manufactured. All right, so we had 0 to begin with. We made $68,000 more. So how many goods were available for sale? Cost of goods available for sale. You're going to add those two, you get 68,000. All right, and then we need to subtract our ending finished goods, which is right here, 5,700. Ending finished goods. So what's going on is our goods available for sale was 68,000. So we had $68,000 of goods available for sale. At the end of the year, we only had 5,700 of those left. So how much did we sell? It's the difference. We're going to take 68,000. We're going to subtract, again, this is optional, 5,700 gives us cost of goods sold of 62,300. All right. Now, gross profit is just simply the sales revenue minus your cost of goods sold. Subtract those two, you get 42,700. And now we need to subtract our period costs, also known as selling and admin expenses. So let's go up here. Which ones of these are selling and admin? Well, the first one is the sales salaries, 5,000. Copy and paste, sales salaries, expense. Then we have our delivery costs. That's definitely a selling expense, 1,800. And do we have any other? There we go. Customer service hotline costs, $1,000. That's for definitely not a product cost. So that's going to go in the selling and admin, customer service hotline. So we're going to add these up. 5,000 plus 1,800 plus 1,000 gives us $7,800 of total selling and admin expenses. So we're going to take our gross profit, subtract our selling and admin expenses, and that gives us a profit of $34,900. Okay, well, I don't think we need that anymore. Now, it says, how does the format of the income statement for Yum Yum Treats differ from the income statement of a merchandiser? So a manufacturer's cost of goods sold, so we're talking about this calculation here, is based on, well, it's based on the cost of goods manufactured. That's the difference between this and a merchandiser. So it uses cost of goods manufactured. In contrast, a merchandiser's cost of goods sold is based on what? Well, they don't manufacture their goods. How do they get their cost of goods sold? Well, based on merchandise purchases. All right, Yum Yum Treats manufactured 17,600 units. So that's the quantity. And it says compute the company's unit product cost per year, round to the nearest 10. So how do we calculate how much these costs, these units, 17,600 units cost? Well, the way you do that is you're going to take the cost of the units divided by 17,600 units. So up here, which of these numbers is the cost of those goods that were manufactured? Well, right here. So we're going to take 68,000. Let me use this. I haven't used this for a while, calculator. So we're going to take 68, come on, 68,000. We're going to divide by 17,600 units. Gives us 3.863636363636, blah, 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 blah. All right. So what are our rounding rules? It says round to the nearest cent. So is it 3.86 or is it 3.87? Well, the 3 here means we need to round down. So 3.86. So what this means is for each of these pet chew bones, it costs $3.86 for the company to manufacture them. So what should they charge for them? Well, it needs to be above that. Otherwise, they will not make a gross profit. And they must have done that because they got, not only do they have a gross profit, they also have operating income.